Hello, with me today I have star investor Bill Ackman, CEO of FTSE 100 company Pershing Square Holdings. Hi, Bill. Thanks for joining me today. Great to talk again.
Sure. Good to see you.
I'm going to ask you to look into your crystal ball and give a view on inflation and Fed rate policy. I know you have written about it at length, but for our viewers, who will want to know, I mean, are we nearing peak inflation, and where will the Fed funds rate peak and when?
Sure. I think we are nearing peak inflation. I think this most recent number was a surprise to the upside, particularly on the goods side. And what's interesting about managing interest rate policy, the job the Federal Reserve has to do, is that the data sort of seems to be always wrong, and constantly being revised. And we were, I would say, surprised, certainly on the goods side of the CPI number. Goods inflation was higher than what sort of anecdotally we perceive is happening in the world. And I would say it was maybe lower in a previous CPI print, and maybe averaging the last two CPI prints probably gets you closer to what the actual monthly inflation is. We do think inflation is moderating. Obviously, at least in the U.S., gas prices have come down, quite meaningfully, and you're seeing some moderation in wage inflation, and clearly in goods inflation, and transportation costs are kind of coming down. Supply chain issues are sort of in process of being resolved, and we think that leads to a tempering of inflation. And then, of course, the Federal Reserve is being aggressive. The really clear maybe reinforcement of what the Federal Reserve was trying to say up until Mr. Powell's August Jackson Hole remarks. I think the world kind of woke up that the Fed was serious. So I think now the market is pricing in even more aggressive interest rate increases in the short term than the Federal Reserve has suggested. And I think the market may be actually, it was the expectations were too low before, and they may be too high now. I'm not convinced the Federal Reserve is going to raise rates to 4.25% by the end of the year. I think they may go more slowly than that, but I think the so-called terminal rate, likely will be something with a 4 in front of it, and we'll probably get there by sometime in Q1. And I think you'll start to see a moderation in the CPI numbers over the next several months, or certainly we hope that's the case. I think a more interesting question, and I would say more relevant to the value of companies, is long-term inflation and long-term interest rates. And that's where I think the Federal Reserve's view that we're going to keep policy tight until we get back to 2%. I'm not sure we're getting back to 2%. I feel like we woke up in a different world in 2022 than the world that came before, where it was hard to keep inflation at 2%, right? And I think the war in Ukraine, I think the China-Taiwan potential conflict, and the supply chain problems that people are having, all of these things point businesses to I want to have more control. I don't want politics to interfere with my supply chain. And so I think you're going to see a lot more manufacturing being brought closer to home. I think Mexico will be a big beneficiary. The United States, I think, will be a beneficiary of that. But that's expensive. And I think, the sort of ESG movement is also expensive in terms of the incremental cost to be a more carbon neutral world. The transition to alternative energy is going to be expensive. So I'm not confident the Federal Reserve is going to get inflation back to 2%. And I think they may have to, at some point, say, look, we're going to accept, maybe 2.5 or 3% kind of longer term inflation. So I think that's a story that has yet to be written. But that strikes me as sort of more interesting. I mean, a lot of focus, obviously, on the Fed in the short term. That's more for traders. We own, and it's relevant to us as we hedge some of those, we use some of those instruments. But what really matters to a long-term owner of equities is what's the long-term risk-free rate, right? Because Universal Music is a forever asset. So when you value it, you discount the cash flows back at a long-term interest rate, discount rate. And so what the risk-free rate is, that's the base on which you add a risk premium. And if it's going to be 3, if inflation is going to be 3 instead of 2, that means something for long-term rates and long-term values.
So companies with pricing power are going to be the premium, one would imagine.
Yeah, and I think we own them. If you look at our businesses, we love businesses that have kind of royalty-like characteristics. Universal owns a royalty on music. So if Spotify raises prices, we get an immediate benefit. Uh, Restaurant Brands owns a royalty on, Burger King hamburgers and a Coke and a fry, or a Popeyes chicken sandwich. And if they raise prices, we get a royalty, an immediate benefit from that. And same thing's true for Hilton. As room rates go up, that's again, and hotel real estate is really the only real estate where you can reprice your rents every day, which is good in a world where you think hotel rents or room rates, our so-called RevPAR, is going to go up, sort of over time. So I think we've always been interested in owning assets and companies with pricing power. The best businesses in the world have pricing power, and we always wanted to own businesses that were protected from inflation, but we never had inflation. So now we do, and we're glad we own what we own.
The recession is fairly likely. I mean, do you see that as a fairly long and severe, or just a short, sharp, technical recession?
Look, I don't think it's knowable whether or not we're going to have a recession. It used to be we had economic cycles with recessions. It's been an awfully long time. But if the Federal Reserve got behind in raising rates, and now they're going to have to be more aggressive. I mean, you look at what's going on in housing. People got used to a 3% mortgage rate, and now it's 6+, and that's causing housing market to slow down fairly rapidly. Housing is a pretty, very important part of our economy. So if rate rises have that effect more broadly, then I think it's likely that you're going to have a recession. If the Fed raises rates pretty quickly, which is what our kind of recommendation, more than a year ago, and you can sort of cut off inflation and get it trending in the right direction, then they won't have to be as severe and don't have to, if you will, force us into a severe recession. But I think sometime in 2023, it's absolutely within the realm of possibility that we're going to have a recession for sure.
Bill Ackman, CEO of Pershing Square Holdings, thanks very much for joining me today.
Thank you very much.